สัมมนาอันนี้อีกครั้งหนึ่งนะครับผมก็ต้องขอบคุณพีอีกครั้งหนึ่งนะฮะว่าเพราะหมอนิสาก็เป็นคนที่แบบช่วยเหลือทางสมาคมมาตลอดนะฮะที่มีสปีกเกอร์ดีๆมาอย่างต่อเนื่องนะครับเดี๋ยวผมเล่าให้ฟังไอ้ preamble นิดหนึ่งนะครับว่าไอ้ตัว topic วันนี้เนี่ยนะฮะผมเองก็ยังไม่ค่อยเข้าใจเท่าไหร่ว่าไอ้ strategic beta มันคืออะไรนะครับแต่ไอ้ตัวนี้มันเป็นเทรนด์ใหญ่นะครับไอ้เรื่อง exchange traded funds หรือที่เรียกว่า ETF เนี่ยนะฮะเมื่อวันก่อนผมไปเข้าอบรมไอ้ single license นะครับแล้วก็มีอาจารย์คนหนึ่งที่หอการค้าเนี่ยนะฮะคือเขาทำ research ออกมานะแล้วบอกว่าไอ้ตลาดไทยเนี่ยมันก็มีประสิทธิภาพในระดับหนึ่งนะครับสำหรับคนที่เรียนไอ้ตัว efficient market hypothesis มาเนี่ยนะครับคือมันไม่ใช่ weak form efficiency เนี่ยมันไม่ใช่ไงแต่มันก็มีในระดับหนึ่งที่มันมีประสิทธิภาพนะครับแต่เป็นที่น่าสนใจนะครับว่าในต่างประเทศเนี่ยนะฮะว่าตลาดมัน efficient มากจนกระทั่งว่าไอ้ผู้จัดการกองทุนทั้งหลายเนี่ยนะฮะคือ80%เนี่ยไม่สามารถจะเอาชนะไอ้ตัวดัชนีได้นะครับคือเหมือนกับว่าเวลามีข่าวอะไรออกมาเนี่ยนะฮะทุกคนมันจะ react ทันทีจะซื้อจะขายหรือจะถือเนี่ยนะครับแต่เขาบอกมันเป็นทฤษฎีกันที่ค่อนข้างน่าสนใจว่าประเทศไทยเนี่ยนะฮะคนซื้อขายเนี่ยเป็นรายย่อยค่อนข้างเยอะนะครับและอันนี้เขาอาจจะเป็นเหตุผลตัวหนึ่งนะครับเวลารายย่อยค่อนข้างเยอะเนี่ยนะอาจจะไม่ได้ react เท่าที่ควรนะครับแล้วก็กลายเป็นว่า50%หรือครึ่งหนึ่งเนี่ยนะครับของผู้จัดการกองทุนทั้งหลายเนี่ยนะครับก็ยังสามารถที่เอาชนะไอ้ตัวดัชนีได้อยู่นะครับมันก็เป็นทฤษฎีที่ค่อนข้างน่าสนใจนะครับคือมันเหมือนกับว่าเวลามันข่าวออกไปเนี่ยนะฮะว่าทุกคนได้รับข่าวพร้อมๆกันนะแต่ลูกค้ารีเทลอาจจะไม่ได้ตัดสินใจนะฮะเท่ากับพวกลูกค้าที่เป็นตัวพวกฟันทีเดียวนะครับงั้นวันนี้ก็คิดว่าน่าจะเป็นท็อปิกที่ดีนะครับที่จะมาฟังในวันนี้นะครับso I just like to take this opportunity to welcome our speaker today. Keep on getting your name wrong actually. Keep on thinking about Jackie Chan, but it's actually Jackie Choi from the Hong Kong office of Morningstar. On behalf of Thai Financial Planners Association, just like to welcome you to our little get together, and especially that you have to brave the travel warnings to be here with us today. So I'm especially grateful. Okay, so the topic today will be on strategic beta and using ETFs in combination with active managers. So Mr. Choi would like to spend about an hour and a half, presenting, and then we open the floor up for Q&A. Okay, thank you.
Hi, hello. So thanks everyone, and thanks for the introduction. And don't worry about, I'm not too worried about the truck warning, as I see it very peaceful in Thailand here, in Bangkok here. So I'll come here more often, hopefully. And so thanks for the introduction again. And I'm Jackie Choi, ETF strategist with Morningstar, and I'm based in Hong Kong. Sorry, I cannot speak Thai, so I'll be speaking in English. And today I'll be talking about strategic beta and using ETF in combination with active managers. So I think just want to get a little bit sort of a statistic here. Who have been using ETFs before? Just one, two, three? Or advising clients to use ETFs? Are you planning to advise people or your clients to invest ETFs? Okay, I hope I would see more hands after this seminar. So I'll give you some context around this particular hot topic on strategic beta, and also showing you how to use ETFs with active managers, which we call it mutual funds in the US. So getting into sort of a bit of introduction about Morningstar ourselves. So Morningstar is an independent research provider. We offer tools, data, and research to different investment communities around the world. So this map, we have the dots on the global map. These are the different offices that we have. And yes, we have an office in Thailand too, and we have our colleagues, Pete here, our CEO in Thailand, also our other colleagues here too. So if you have any questions about Morningstar, please feel free to contact them. So, and myself, I'm the ETF strategist, and I oversee research activity for Morningstar in the Asia Pacific region. So Hong Kong, Singapore, Taiwan is for now my main markets that I look at. And Thailand obviously is included in Asia. And hopefully when the ETF market gets bigger and more active, I'll be looking more into this particular country too. So, and a bit of running down today's agenda here. This seminar today will be split into 3 main parts. I will dedicate the first part to the topic on strategic beta, from what it is and to defining it, and to looking deeper into the taxonomies. And then in the second part, I will talk about the latest trends in the ETF industry. And in the final part, I will share with you on how to use ETFs along with active funds. So hopefully that would sort of form a more sort of complete picture on how to use ETFs on different levels. So, strategic beta. Another time to show your hands. Have anyone heard about strategic beta? Just 1 or 2. Maybe you have attended the seminar yesterday too. And what about smart beta? Have anyone heard about smart beta? A little bit more hands. Well, it's actually similar. But the reason why we're talking about this particular topic is that for many years, many around the world, many around the industry have debated the specifics on how to call this smart beta, strategic beta, and how to define it. And as an independent party in this arena, we at Morningstar is uniquely positioned to actually put an end to this debate and to move the conversation beyond the simple semantics. Well, basically, what's the meaning of it? And focus investors' attention to the key questions that they're facing today. For example, are these products or strategies have lasting investment merits? How do I separate the good, the bad, and the ugly? And how do these strategies fit within the context of my existing portfolio? So step 1 down this path is focusing on putting an end to the debate around semantics. So as such, I'll be dedicating a substantial portion of the presentation on defining strategic beta and the taxonomy that we are going to develop to help investors make sense of what it is, a very broad and diverse and increasingly complex group of investments. So a lot of words here. Sorry that it is a little bit pale, but you can listen to me, which is similar to what it says here. So in many countries in the U.S., well, many places in the U.S. and Europe, we've been having a lot of different seminars talking about strategic beta, smart beta. In fact, many of the investors are more familiar with the term smart beta. And the term itself has gained a lot of industry traction, especially in the US and Europe. And we have actually been using this term ourselves as well. But when we approached this exercise of defining and classifying this universe, one of the first steps we took was to kick smart, this term, out of the picture. The word smart is, I think, a little bit confusing because it would imply these strategies to be intellectually more superior relative to the normal benchmarks, for example, the S&P 500. Is that right? Well, we don't think so. Not every smart beta product or index is actually smart, so be careful. This is why we have opted to use the term strategic, and that's why we call these type of product strategic beta instead of smart beta. So I hope you will be using strategic beta from now on. And this term, I think, is more fitting because as many of these benchmarks actually, and then products that it tracks, these indices in these categories are designed to mimic the same sort of strategies that has been used by a lot of active managers for decades already. So let's start to define smart strategic beta. It is actually a growing category of indices that ETFs and other funds and investment products are tracking them. The majority of these indexes seek to enhance returns or minimize risk relative to our traditional market cap weighted benchmarks. Some others seek to address some drawbacks of the traditional commodity future indices. You may have heard of contango. These strategic beta products try to mitigate these problems, and fixed income indices too, because you would probably heard about fixed income indices are heavily invested into the indebted companies, and these strategic beta products tries to mitigate that problem as well. And in the middle of, when we speak about like strategic beta, it's actually sitting in the middle of active and passive, like the son of mother passive and father active. So similar to active managers, these benchmarks and the relevant products exploit many of the same source of returns, such as size, value, and quality aspects, or mitigate risk, or such as a volatility tilt. And similar to passive portfolios, they are rule-based, transparent, and relatively low cost, but with a strategic element in there. And I talked about cost just now, so just for your reference, looking at the end of last year, strategic beta ETFs have an average expense ratio of about 53 basis points, comparing to about 120 basis points for actively managed open-ended mutual funds in the US. So you can see the difference in terms of cost here. It's much cheaper to own these type of products than normal active funds. So I talked about the definition, and also, so now it is also important to sort of introduce you to see how we are different from the others that are using this particular term, smart beta or strategic beta. In fact, a lot of them in the industries are including indices that are not market cap weighted into strategic beta. Well, similar to us, we do that too, but in fact, some of the benchmarks, strategic beta products that we categorize are also market cap weighted. For example, those have a style tilt. For example, a dividend weighted benchmark, which first of all, they screen out the different constituents within the index by looking at the high dividend yields, and then subsequently weighting them by market cap weightings. So this is a time where these type of strategic beta products have the active portion in there, as well as having the market cap weighted mechanism in there too. And in the labeling process, we do not include any pure sector indices or country indices, and anything in our trading category, such as leverage or inverse products. So at this point, I would probably apologize for putting 1,000 words before this particular picture, and which this picture hopefully should go a long way towards helping you to understand our concept of strategic beta. So again, strategic beta is a hybrid between the active on the right and the passive on the left. And allow me to use, again, the analogy of strategic beta being the son of a passive mother and an active father. So like its traditional passive mother, these products track rule-based, such as normal passive products. It's rule-based, and they are transparent and cheaper to own than the average active managed funds. And they also possess the active father characteristics in that they have embedded an active bet against a broad market portfolio into the construction of their benchmark index. So basically, you remember that normal actively managed funds have fund managers to pick the actual stocks within a universe, but these strategic beta products have the rule-based indices that have the rules written down in the rule books, and they will execute exactly like what is written in the rule books. So you have the active and the passive portion in there. And as I said, it is also important to note that we include certain benchmarks that weight their constituents by market cap, capitalization in this category. So many of the rule-based passive products are actually market cap weighted, and we do include some of those in the strategic beta portion. And as I mentioned, these indices will start with a broad-based benchmark and screen the constituents for certain characteristics, such as value, growth, or dividend-related attributes, and subsequently market cap the weights and for the results. And again, the common elements of the strategic beta, they're index-based, transparent, cheaper to own than active managers, and a little bit more expensive than normal ETFs that are tracking the bulk indices, for example, the S&P 500. So now I've walked through the definition of strategic beta. Now I would like to spend some time highlighting the trends in this particular strategic beta space. And this is basically why we are spending so much effort in putting these into our work these days, and also putting these strategic beta attributes and definitions into our different products as well, so that we can do the other research based on these products. So as of the end of last year, there are 355 ETFs tracking these kind of strategies, strategic beta, and the asset under management is close to 300 billion already. Well, what's that number represent? It actually represents 17% of the overall US ETF sector, so which is a pretty big portion already. And looking at the net cash flow, almost a third, 31%, last year actually went into these strategic beta products. And looking at the actual AUM of these strategic beta products, they grew 54% over 2012. And looking one level deeper, 30% actually come from new cash flow, and only 24% comes from asset appreciation. So it's actually the more product that came into the line and more money getting into these products that actually result in the strong growth that we are seeing in this strategic beta segment. So another picture that you can see the growth in this category asset, dating back to the inception of the first strategic beta ETF. And a strategic beta is actually not that new a concept. It actually started back in like May 2000, when iShares started their first batch of strategic beta ETFs with some growth and value ETFs launched back then. So these I would call these as the first generation of strategic beta products. And fast forwarding to 2005 here, you can see the first fundamentally weighted ETF launched, and also the first non-traditional commodity ETF launched shortly after that in 2006 too, both by PowerShares. And fast forwarding further to 2011, you can see PowerShares launch another volatility weighted ETF. So, and you can also see the very fast growing 54% growth in that particular year too. And you can see it's just a very substantial exponential growth you can see here. And looking at a different angle for this growth in the strategic beta, it's actually not just an asset appreciation story, as I mentioned. The growth has been driven by increasingly strong and steady cash inflows. And you remember that I just said there was like a third of the new cash flows went into this asset. These are the actual cash flow that went into these products. But looking at the number of launches, there are also a lot that has been launched in the past few years. Looking at like 2009, there was only six strategic beta ETPs launched in the US. 16 in 2010, but the growth has been tremendous in the past 3 years, 2011, 2012, and 13, averaging 46 each year. So you can see the growth there. And that's also driven the strong inflow too. So this is a more complicated chart here, which I think I would put a little bit of explanation here first. So Morningstar has a Morningstar rating system, rating funds and ETFs from 1 to 5, based on the how well they have performed on an after fees risk-adjusted basis in comparison with similar funds. Top 5%, top 10% receive 5-star, bottom 10% receive 1-star. So 5 stars perform much better than the 1-star, and 35% in the middle receive 3 stars. And so this picture actually shows you what? It shows you that the money actually goes into the better performing funds, better performing ETF, especially for the strategic beta products. You can see in terms of asset, in terms of number of accounts, strategic beta has performed much better, classified into the 4 and 5 much more than the traditional ETFs. And that's why a lot of money has been going into this particular segment. So I've talked about like 20 minutes already about strategic beta. Why are we doing this? Well, it is actually our overarching goal to help investors to reach their financial goals in understanding these complex products. So as analysts at Morningstar, all of us are trying to be the referee in this arena, and by laying the ground rules. That's the definitions here. And then by doing so, we can then classify them, and then highlighting the winners and call out the losers. So we can then perform research to see which are the good ones and which are the bad ones, so the investors can make their investment decisions upon them. This is all being done to help investors to navigate this increasingly complex landscape. So up until now, I've been speaking about strategic beta in a very broad terms. As I mentioned at the outset, this is a very diverse category, and we are working to develop a classification scheme that allows investors to drill down into the broader universe at a more granular level. And here we have an outline of our 3-tier taxonomy mapping the system, mapping this particular strategic beta space. So we have risk-return, risk-oriented, return-oriented, risk-oriented, and others. So basically, when we have an ETF on hand, we'll first ask ourselves whether this ETF would fall into the strategic beta sort of criteria, after which we'll put them into different buckets. So going into the 3 primary strategy attributes, return-oriented strategies look to improve returns relative to the standard benchmark. Value and growth benchmarks are primary examples. Risk-return oriented looks to either reduce or increase the risk level so that investors can pick their own risk level to invest into. Low volatility or high beta are the most common examples. And the other classification encompasses a wide variety of strategies. And these range from non-traditional commodity benchmarks to multi-asset indices. And I'll then spend a little bit of time going into each of the different categories. Risk-oriented, for example, we have dividend screened, sort of the attribute as the secondary attribute. Dividend screened strategies seek to deliver equity income by employing a number of dividend-oriented screening or weighting criteria. And these include screening at universal stocks or for dividend-paying firms, weighting stocks on the basis of dividend payments, screening on the basis of dividend growth, or isolating firms or metrics that whether they are paying or increasing dividends. So there could be very different rules based on for these category. And second, value. Value strategy will screen a segment of the stock market looking to identify those stocks that display value characteristics. These characteristics will differ across different index providers. Common value characteristics are low PE levels, low price to book levels, low price to sales ratios, etc. And it's just important to note that some of these strategies weight the results of their screening criteria by market capitalization too. And we'll talk a bit about growth too. The growth attribute will screen a segment of the stock market looking to identify those stocks that display the growth characteristic. These characteristics will differ across index providers. Common growth characteristics include above average long-term projected earning growth, historical earnings growth or sales growth, etc. And also some of these strategies are also market cap weighted. And looking at fundamental, it is the case that refer exclusively to the RAFI, RAFI, or RAFI fundamental index equity strategy, which is an institution that weight and compute these indices, which will select and weigh their constituents based on fundamental measures such as sales, adjusted sales, and cash flow, dividends, etc. So you can see that there are a lot of non-traditional reasons or criteria when selecting the actual constituents into the index, and this is what we call the strategic part of the of these kind of products. And secondly, we look at like risk-oriented. So low minimum volatility variance strategies select and weigh their constituents on the basis of historical volatility. High-low beta, we look at they select and weigh their constituents based on their beta relative to the standard market cap weighted benchmarks. And finally, the other category, the others attribute. So there are non-traditional commodity. So I mentioned a bit about like contango and for the commodity, normal commodity index. So here for strategic beta indices on non-traditional commodity, they try to use some methodology to mitigate that particular process. And equal weighted, they simply apply an equal weight to their constituent securities. For example, if they have 20 stocks in their constituents, every stock will have a 5% weighting instead of normally market cap weighted sort of method. So that's pretty much it for the strategic beta sort of introduction. Are there any questions that you may have before I go into the next section?
I'm afraid you lost me. So has Morningstar diversifying to index construction now?
No, we are actually providing these particular sort of definition and attributes so that when we see there are different index or products that are linked into these indices, then we can use these different attributes and put these products into our database to make apple to apple comparison to each other. So say for example, if there are two indices that are index A and index B, you can quickly in our database we can see that what they belong to and whether we can compare them apple to apple. Because
let's suppose they have money in just plain vanilla S&P 500 index ETF. Do you have a historical performance data to compare this with, say, the strategic beta?
There will be, yeah. There will be under our different product platforms. So, for example, index or an ETF that tracks an S&P 500, we will have return data and also NAV or other portfolio data for this particular ETF. If there's an ETF tracking a strategic beta, which is a dividend, high dividend S&P 500 ETF. We will also have the actual data on the actual return performance on this particular ETF, and we can make comparison to each other. And if there's a third ETF that is tracking another dividend-based strategic beta index, we could compare the second and the third ETF together to see, okay, by quickly using these sorting systems, we can compare them quickly and see if they have under the same category, have they performed better or worse? So we are playing the referee here. We're not saying that we are going into the computing the index, but we are trying to stop the argument of what to call it, how to classify it. These are the definitions. Right. So no more questions for now. So I'll go into the second section here today, which is to introduce you with some recent trends in the global ETF industry. So this is the picture of the different AUMs, asset under management of ETFs in different major regions, Asia Pacific, Europe, and US. You can see US has definitely been the largest of all, which is the blue bars, and over the past 5 years, ETF asset under management has tripled over the past 5 years. It's a very tremendous growth here. And the blue line AUM in the US ETF has increased a compound annual rate of 27% over the past decade. So you can see the very strong growth in these particular asset class ETFs here. I think one of the reasons is because of the low cost that it has, because cost has been one of the strongest predictor of performance of a fund or ETF, and low cost actually helps investors' performance. And so first of all, let's look at the US story here. The growth has actually not been, isn't just driven by asset appreciation. In fact, a big portion of the growth actually came in from inflows. And here you can see that the rightmost bar here is a net flow into the US listed ETFs, which 2013 made another new high in the past 10, 15 years. And another look into the US fund industry that we found interesting is that the trend of assets flowing into the passive products, of which ETFs belong to passive. Passive meaning that rule-based instead of fund managers making the investment decisions. In the past 20 years, the importance of passive products have been increasing, accounting from only 3% 20 years ago to some 27% nowadays. So you can see the low-cost reason has driven the very strong growth in the past flowing into the passive products from actively managed products. And looking at Asia, where Thailand belongs to, looking at Asia, although the red bar is still very small comparing to the US ones, actually if you sort of magnify that, the exponential growth is similar to what you see in the US, also exponential. So a little bit of context here. Size of the Asia Pacific ETF market is 1/10 of the US, and Europe and Europe is 1/4 of the US. So you can see sort of like the some comparison here. And this picture sort of shows you how assets and sort of number of ETFs are listed in the different countries of the Asia region. So looking at the biggest one, you can see Japan. Japan is one of the first movers, including Hong Kong, first movers into the ETF market. So Japan has been very active in launching ETFs, and one of the countries where I think government is very willing to use ETFs too. And I recall that the asset purchase plan by the Japanese government in recent years also include ETF purchases, and you can see how supportive the government is on the ETF industry. And so you can see AUM is the biggest for Japan within the Asia region. Second is Hong Kong, 33 billion. We have also got a very big number of ETFs, 134 now. And looking at the third in terms of AUM, China is coming in very quickly. It wasn't on the third 2 years ago, and it has come into third now, beating Korea. It's now at 22 billion AUM and only 82 ETFs nowadays. This growth would definitely be stronger as the China market further opens, as well as allowing more different product offerings in the country. Following that is Korea. Korea is 17 billion, but there are a lot of ETF offerings, 149, at which Korea is actually very active in launching very different types of ETF products, from the traditional ones that they track the Kodaks or the Kospi, or even going offshore, tracking the S&P 500, etc. They have also got a very big portion of sort of more exotic type of ETFs, which are inverse and leverage ETFs, which they offer leverage, meaning that they offer 2 times of the traditional index return. Inverse being like if the index go up by 1%, the ETF goes down by 1%. So this type of inverse ETFs. These are, well, we haven't seen that in Hong Kong or Thailand yet, but they are very attractive in Korea. I think some of the reason was because Korea people are very trading oriented. They like to use these these ETF as trading products. Not that I encourage people to use ETF as trading products, but that's how they have been using it. So looking at the other countries, Thailand, I would say Thailand is still on the infant stage in terms of ETF industry. Only 400 million of AUM so far, 18 ETFs in the market, of which 12 are equity ETFs, 2 of which are investing offshore, 5 gold ETFs, and 1 fixed income ETF. I would say, well, if the regulations and government would be willing to promote it a little bit more, and maybe like the stock exchange would like to promote them a little bit more, I think the growth can be a lot bigger, because ETFs, being a low-cost vehicle, has its own reason for existence in many countries, especially offering the market growth, market return to investors without people needing to invest in a lot of stocks, but just one ETF can do the work. So this can help diversification, as well as for other ETFs tracking offshore market, you can bring capital out of the country too. So this is the current picture of the ETF market. Here is what's next. So recently, a month ago, Singapore, Australia, Korea, New Zealand, Philippines, and Thailand released a consultation paper on the proposed rules and arrangements governing the operation of the proposed Asia region funds passport. I think this is a suggestion of the different countries willing and wanting to get their funds and ETFs into and out of their own country. And this would obviously create more flows into different products, and also sort of helping the asset management community too. And so what I would expect is, would there be more ETFs available in the Thailand market? I think so, because probably a lot of foreign fund managers would be wanting to come to the Thailand market to allow Thailand investors to invest offshore, well, subject to rules and regulations, of course. And also, probably Thai managers would want to go to other markets to launch some Thai market, some ETFs into other markets, which tracks the Thai industry to get external money into Thailand too. So this hopefully is how the ETF market has been building across Europe, getting money in and out of different countries. And I think with the ARFP, that this would be a chance to broadening the ETF platform in Asia. Currently, I think one of the problem, well, I wouldn't say a problem, but I would say an obstacle about the Asia market is that every Asia market is a single country having their own regulations and having their own exchange. There are a lot of rules, a lot of different regulations. Whereas in the US, you have a single rule covering the whole country. In Europe, you have UCITS having a very broad and general united rule in covering the whole Europe. That would help the country, the actual platform to grow. So with more united, like for example, this kind of Asia region fund passport, or even in Hong Kong, China, there is the Hong Kong China funds passporting. So hopefully that would build a stronger ETF platform to allow different ETFs to be sold in different countries and activating more flows into different countries and out of different countries too. So that's about it for the industry trends. Do you have any particular views or comments that you would like to give here, or questions that we would like to ask on the trends?
Just a couple actually. You say ETFs in Asia. Are these actually ETFs that are managed and provided by the local fund houses? Let's say in Japan, they've got what, $79 billion worth, and are these provided by the Nikkei and the Nomura's AMs of this world, or are they the black rocks that are the ETFs that are listed in Japan?
If you're talking about Japan, the Japanese market in particular, local ETF providers are still the dominant players. The ones that you talk about, Nomura or Nikkei, are the bigger players. But iShares in Spider, which is State Street's ETF arm, has already entered into the market too. But if you look at the other market, which is Hong Kong has. If you look at the bigger ETFs, which is the Tracker Fund of Hong Kong, 2800, and the other bigger ETF, 2823, the iShares China A-Share ETF, these are by obviously Spider and iShares. These are all foreign ETF providers. I think they are, well, I think one reason is that they are lucky enough to be one of the first to enter the market, and also it was the ones that have the experience in launching products in US and first being invited to launch ETFs in the region, in Hong Kong. And I was looking into like Thailand. Thailand, so far, all of them are local players. I think in terms of like development, I think there are a few aspects. One, regulators has to do their job in allowing other players to come into the market, so that knowledge can be shared from the US and Europe. Just like Hong Kong, they invited other ETF providers to go into the Hong Kong to launch ETFs, so that local players can understand how ETF work and how ETF can be operated. And I think that would, if Thailand can do that too, that would help the industry too, so that there would be more competition and getting more of product offering as well. And usually you can see the local ETFs are usually locally managed. Well, even in different countries, you have like US, usually iShares and Vanguard are the bigger players, and you see they are the ones that have locally listed and local exposure ETF that are very big. And
I'm not quite so sure whether the stock exchange has any objections. So let's say if iShares want to list their S&P 500 ETF on the SET, I would have thought that there's no restrictions. Yeah.
No restriction. We are open for cross-listed ETF so far. But
But it has to
as he mentioned, all of the ETFs here are locally
I think the size sort of issue is one of the reason why foreign ETF providers has not been entering Thailand. Because for the case of like iShares or State Street in Hong Kong, you can having a foreign provider providing an ETF in Hong Kong, they can get use their foreign money, foreign investors to put money into Hong Kong. But if say for example an ETF provider looking at Thailand, if the size is small, they may not want to even put their first money into here to start the business. So it's like a chicken and egg problem, whether there is some sort of first move into the market first to grow the market, and then get the engine started and grow the market subsequently. So maybe, well, the government or stock exchange can probably talk to the different ETF providers more, maybe.
I think my biggest fear is that growth may bypass the SET completely. You know, as in, let's say that I'm a Thai-based investor here, and I want to invest in S&P 500 ETF. So go down to the local brokers here that can execute offshore. You know, these are the ones that are already listed on NYSE. You know, Patra can do it, IRA can do it. So I don't really need these products be listed, you know, on the SET, which is a pity.
That's one.
So the growth may not actually happen in Asia. Actually.
I think I would put your sort of concern into two folds. One is whether we need like overseas, well, locally listed ETFs having an overseas exposure. This is a key question because, as you said, it could be very easy to buy foreign listed ETFs, but there are risks in there too. For example, tax issues. That's one thing you have to understand before investing into that. But if you have a locally listed foreign exposure ETF, you may be very happy with the your Thai tax system before executing. So, and a lot of retail investors probably would be more familiar, more sort of familiar with the trading of the SET rather than trading and using offshore platforms. So that's one way to put your concern. But I would say yes, if the cost or sort of risk and reward makes sense, probably investors would go to the other countries to buy ETFs too. So I think if there's sort of overseas providers coming in, they have to put the cost in sort of like into consideration too, in how to like break the market as well. And the other part of your concern, I think, is whether we should have like locally listed, local exposure ETFs. I think I also have this conversation with my colleagues as well. As if you have like 500 stock in the stock market, having an ETF to invest for you may not be that important because you can easily buy your 500 stocks, everything in the stock market yourself easily already. But if you look at like a bigger market, say the US, you have 10,000 stocks, say, in the market, and an S&P 500 invests into only 500 stocks, and that ETF helps you to get that particular exposure. And that index is something that you are looking for. That ETF will be a good vehicle for you to get that market exposure. So I think there's a sort of like a growth sort of vicious cycle. As the market develops, there's more need for an ETF. When there's an ETF that helps market flows, and that goes on and on and on. So and I think ETF, after all, is a good tool for you to provide you with the return of the market index, and market index is usually the ones that that is more familiar by the local investors, and so ETF is one way for people to access that that particular market. So I would look forward to more growth into from the Thailand market, and then subsequently having the growth in the ETF market too. So hopefully that covers your concern. Right. So The third part of my presentation today is using ETF in combination with active managers. So I asked the question about who have used ETFs. So I would like to ask another question. Who have used active funds, like normal mutual funds, in your investment portfolio or your client's investment portfolio? More than ETFs. So that hopefully will let you know how to use ETF more going forward with your existing portfolio of mutual funds, active funds. So I'm using this picture again because it helps to understand the active and passive a little bit more. So let's talk about the investment approach first again. So active investment approach is to make specific investments with the goals of outperforming in a benchmark. Generally, mutual funds are big players in this field and are trying to beat market indices and benchmarks. Well, you wouldn't like fund managers that lose money for you, right? And our passive investment approach is to invest in accordance with predetermined strategy that does not entail forecasting. So mimicking an index is one of their objective. Not over, not below, but mimic the index, where we have most of the ETFs doing this job, or index funds are doing this job as well. So these are typical passive investment products. And now let's look at the different vehicles. The active managers, so the actively managed mutual funds, they try to outperform the opportunities, try to outperform a benchmark. Potentially, they could reduce the risk if you have a very seasoned active manager that is doing the good job. Maybe they could reduce the risk in certain markets. So if there's another financial crisis, they may have the skills to outperform the market, or say drop, or having the performance not dropping as much as the general market. So that helps you to get a better risk-adjusted performance. And with ETFs, the primary advantage is lower cost, as I mentioned, and ETFs also offer some trading flexibility, which allow you to use stock-like strategies such as short selling and being able to trade throughout the day. And they also offer consistency of exposure, and it also is a very transparent vehicle. Usually, ETF discloses their portfolio on a daily, or many of them on a daily basis, but mutual funds only tells you like their portfolio every month or every quarter. So that ETF gives you more transparency there. So of these advantage that I just talked about on ETFs, there are also disadvantages. So some people may believe that having ETFs trading a lot, that would increase your trading costs, right? And some people may believe in efficient market hypothesis. They may think, oh, if active managers are trying to get more return, they have to take more risk. There are also some concern here too. So that's why I'm here to introduce you to how to get the advantage of the two together and blending active and passive investment vehicles together. So again, the cost. So this shows the key advantage for ETF. In the US, average ETF costs about 55 basis points. If you're averaging out all the open-end mutual funds, 120 basis points. Even open-end index funds, they charge like 81 basis points. So ETF is actually a cheaper product to own on a pure expense ratio basis. And actually, why is this important? Because if you are a long-term investor, these 70 basis points that is accumulated is very important on a compounded basis. So the first strategy that we can use on combining active and index ETFs together, which we call it a core and explore strategy. So in the core, we can actually use some low-cost or broadly diversified passive ETFs. to cover some index to provide you the market returns. And on the explore part, you may be able to use active mutual funds managers to get your alpha, or use some niche ETFs to get a particular exposure, and be your own asset managers to pick and choose different sector or different exposures that you have conviction in. So this is one way to sort of form your portfolio. So in the core, you can buy some stock ETFs, fixed income ETF, and a little bit of cash to form your core. And then in the side, you can either choose mutual funds or ETFs that invest into different segments. If you have a view on oil prices will head higher, you can buy some energy ETF or oil ETFs. If you're concerned about aging population, healthcare would probably be your bet in this particular core and explore strategy here. And if you have a conviction in the China, you can choose a China ETF to do the job on a regional basis, so that core and exposure can exactly help you to execute on your investment thesis. Here is another example. Now here I've used another example of a core and explore type of portfolio, and here I've used some Thai ETFs to form the building blocks, and then selecting a few active managers. I use ETF that tracks the broad Thailand equity market, so I choose the ThaiDex set 50 ETF here, and I also choose sovereign bond market ETF to form my core part. So 35% in the equity and 20% in the fixed income. And then in the explore part, which I would want to find some good sort of managers to do the job to get my alphas. I've used examples in our fund award winners. So an Aberdeen one and a Papoon one for the equity part, and another fund award winning fixed income fund that forms the explore fixed income portion of my sort of this particular strategy here. But bear in mind, I'm just using this as an example. This is not advice to buy or sell these particular ETFs or funds, right? So just talk about the core and explore. The second strategy that I would like to introduce you is called the portable alpha. So remember that ETFs can trade like a stock. So ETFs you can short sell an ETF. So for example, if I have a situation where that I would like to have only 30% of asset allocation in the financial sector, which is my asset allocation target, 30%. But I've got a 40% exposure into financial sector already. So in that case, how can I reduce my exposure in financial sector without giving away my alphas in my chosen fund managers that have 40% in the financial sector? One way is to short sell 10% of a banking sector ETF. So that will reduce the beta exposure from 30% target to a 10%, from 40% to 10% without sacrificing my alpha here. So we are carrying the alphas wherever we want to. So this is called the portable alpha strategy here. Okay, another advantage of ETF is having a variety of ETFs that are available, well, especially in the US and Europe, where basically for any particular asset class that you can think of, you can find an ETF that tracks it. So for example, equity index, you can choose an S&P 500. To country-specific exposure, you can choose a China A-share, or Brazil, and sector-specific, you can choose financial, telecom, etc. So this is this way you can complete your portfolio if you see any holes in your existing portfolio and choose the right ETF in the exact level or proportion that would make your asset allocation at a very precise level. But unfortunately, in Asia, the number of offerings is still limited, especially in Thailand for now. So if there are more ETF that is available, you can make some match to get a more precise exposure. And for now, Thailand actually has a number of sector ETFs to choose from. So I think this portfolio completion can actually work for maybe if you have a Thai exposure fund portfolio, you can use these Thai sector ETFs to complete your portfolio. And here I actually have an example where a portfolio completion example here. Say, for example, if my portfolio currently has two funds, equity funds in there. Again, I'm using the Fund Awards winning funds here, the Pupun and Aberdeen, each have 50% weight, say. And using our Morningstar Direct institutional platform to take an X-ray into what these two funds actually has invested in. These two funds, if you look at the equity sector breakdown, you can see that they are very heavily invested into the cyclical equity sector. So this might not be something that I really want to. So what do we do here? Say, for example, we actually wanted 40% in cyclical and only 30% in, and I would like a more heavy weight in sensitive and defensive to 30%. So say from 15% to 30% and almost 70% down to 40%. How do we do that? I think this scenario is very common. It may be for a case if you have only got two funds in your portfolio that you are comfortable with. You might not be able to find another exact fund managers that you could find which is doing good enough job to have your exact asset allocation 40-30-30. So what do you do with that? So now I would like to plug my holes in this situation. I would like to plug those holes. So what I would do would be to sell 20% of the in each of the two funds and buy 20% into the exact sector ETFs that I would like to gain the exposure in, the equity exposure in. So again, taking the same picture again, taking the same X-ray. This helped to after adding the two sector ETFs into my portfolio, 20% each. You can see that the equity sector breakdown has already increased to about 70 from before 70% into cyclical down to about 40%, and from 16% in sensitive raising to 30%. So this is a very precise portfolio completion strategy that you can perform on by using ETF as well as your existing fund portfolio. So you can sort of use different proportion of ETFs to mix and match to pinpoint into your asset allocation target. Right, so other than these strategies that I talked about, ETFs can also be used as a risk management tool, and ETFs are usually very liquid and transparent, and therefore they can be used in many ways, including like risk management. For example, if there's a slicing and dicing sort of approach, where you can make very precise sort of decision, just like what we did in the portfolio completion exercise, where if you have like a portfolio of fixed income portfolio where you need to get exposure into a different duration, then you can find an ETF that has that particular missing duration to add into your portfolio to get your exact exposure here to manage your risk, because a lot of like fixed income products or fixed income portfolios require precise cash flow matching, and that ETF can help you with that. without the risk of fund managers altering or not knowing your active fund managers' cash flows. And so if hopefully if the Asia region fund passport would be sort of expanding the ETF industry here, I hope that there will be more ETF to choose from to help you guys to risk manage your portfolio even better. So there are other ways to use ETFs. Another way is called the cash equitization. So a lot of times, say you're a fund manager and you have a fund redemption coming up. So say if your AUM is 10 billion and you have say 10% 1 billion redemption coming up, and you probably would want to get the cash in advance in that case. But a lot of times, if you put it in cash and the market is going up, you're losing your sort of performance on that particular 10% because you have cash on hand, and that is obviously called cash drag. A lot of times, fund managers can use ETFs as a parking tool, and they can invest into the using that 1 billion to invest into an ETF to gain the market exposure. And because ETF is a very liquid tool, they can just sell the 1 billion portion right before the redemption is needed, so that can help you to still gain the market exposure without the risk of being trapped in cash or trapped in some low liquidity securities that is in your portfolio. So that's one way of using ETFs. And the other is called transition management. So sometimes if there's a portfolio and a portfolio manager leaves the jobs or being fired, there may be some time in between where there's no one making the decision. So the team would probably can use ETFs as a parking tool to earn market return rather than having no one to make the decision. So this is one of the transition management tool ETF can be used on, and this is also called a stopgap solution in this kind of situation here. So the other way that ETF can be used in your portfolio, liquidity management, and in a number of studies that we have performed in the US in particular, ETF is actually more liquid than the underlying basket. Equity, well, a lot of ETFs are already very liquid anyway, and as well as equity itself. But a lot of the bonds are not actually that active or liquid. An ETF is actually a very liquid tool that investor can get in and out very quickly at good prices, so that a lot of investors may actually want to pick ETFs, especially if you are a large amount of investor, having a large cash that you have to invest in an ETF rather than the underlying individual bonds, which are more illiquid, so that ETF can actually help you to get in and out quickly into that particular exposure. So, getting to the last part of my presentation, I've still got quite some time here, but well, I think I've talked a lot about how we can use ETFs and how to mix it with active funds. I would like to give a very brief sort of ways or method in which investors should actually look at analyzing ETF before investing them. So I think firstly, we should determine whether the ETF is suitable for existing portfolio. So depending on the economic outlook and portfolio focus, and determining the role of ETF, how it would impact your portfolio before investing into a particular ETF. I think I can draw an example here is, for example, if you're investing in already a global portfolio, and you're trying to get more EM sort of exposure into your portfolio, but your global portfolio would already have a lot of EM exposure. So before investing in an EM ETF, you should be sort of doing your homework to understand your outcome exposure before investing into a particular ETF. And especially inside EM, you have very different country exposure. For example, China could be a very big sort of chunk in your EM ETF. And if your asset allocation does not want that a lot of China exposure in your complete portfolio, you should be careful when selecting the different ETFs. Potentially, you could choose an ETF that is EM but without China, or even if you have you could have chosen to invest into another EM but shorting some pure China equity ETF in order to complete your getting to your target asset allocation. So this is the suitability part that you should think about before investing in ETFs. Secondly, we actually would urge investors to look at the key macro fundamental drivers that would affect the ETF performance. Ask yourself, are those fundamentals working on your side? Are those exposure you would like to be exposed with? For example, China, for a very typical China index, is always very financially focused. So what's your view on China financials? Is the bad loan situation something that you are expecting? What's your view on that? So understand these particular factors before investing into a particular ETF. And thirdly, an index tracks an index. So investors should understand how the index is actually constructed, from what the constituents are, how these constituents are sort of exposed into different sectors. As mentioned, just like China being very focused into the financial sector. And also, for example, is investing into Brazil market index really capturing the Brazilian economy and domestic consumption, or really it is to expose to export of commodities. You have to understand the actual sort of exposure before you invest into that particular ETF. Don't just look at the name and invest into it. Be careful with that. So that's on the index construction. And fourthly, product construction. Well, after all, ETFs are different products. You should understand it before you invest into it. So this helps you to determine how closely you would earn the index return, and understanding the underlying risks. Because different product construction can get a different impact on the operating cost of an ETF. So that determines how the ETF performance would deviate from the actual index return. So you have to understand the product construction and also the risk on it. For example, how the ETF is replicating the index. Is it full replication? Is it sampling? Is it synthetic? And if it is synthetic, are there any collateral that the ETF is collecting? That would mitigate the risk. So it's more like a risk and return sort of analysis that we would like to perform before investing into that particular ETF by looking at the product construction. And finally, you will need to know how much fees are being charged by the manager who managed ETF and the total cost of ownership. Don't just look at the expense ratio. Also look at the bid-ask spread. That is one cost that is not written in any prospectus. Is market driven because ETF is being traded on the stock exchange. So you have to look at the bid-ask prices. You have to look at the premium and discount that the ETF is trading. So these are all the all-in costs that you should be comparing against the different available investment vehicles or ETF that you have available on hand before investing into them. So, well, sounds complicated. Well, hopefully not for us, but I think for investors, one simpler way would be to look at our research, maybe, or look at other external research before investing into different ETFs. And I think as a general rule of thumb, investing into ETF is to first of all form your investment thesis. Secondly, choose the right ETF, and thirdly, to execute it. So this is the basic rule of thumbs, and looking at the 5 or 6 steps that I just mentioned, that will help you navigate through the different, the difficult, the very complex space of ETFs. So that's all the time I have. Well, I've actually got quite a bit of time, but that's pretty much all I have to say for today. If you have, do you have any other questions? Or if you have any comments on the Thai ETF sector that you have? Nope.
แชร์ไอเดียไว้หน่อยนะฮะเรื่องอะไรเนี่ยเรื่อง ETF Let me just break ice and throw in some ideas. Would it be fair to say that going forward, let's say 5 to 10 years from now, is back to basic again? As in, the greatest place on earth to invest is North America. Essentially, that's all you need. Actually, S&P 500, listed companies, the Googles, the Microsofts, the ExxonMobils. These are global companies. They happen to be domiciled in the U.S., listed in the U.S., but the revenues are actually derived globally. Half of it is actually, derived from emerging markets, and and all the EM's countries are in the doghouse right now. China, for God's sake, it's been in a bear market for God knows how long.
Yeah.
Indian politics, Brazil, very disappointing. Russia, he's got Putin, and even Europe, they haven't really actually sorted themselves out, have they? So would you agree with this?
Well,
Plain and simple.
well, I wouldn't give any investment advice, but what I feel is that the world is getting more, as you said, global. Whether or not it would happen in the U.S. or not is, I don't know, is a question. But I think as the market further develops, there will be very strong businesses in the U.S., very strong businesses in China, very strong businesses in different countries. So it's a matter of how to get the actual exposures, get the actual companies that you want to invest in. I think probably maybe getting S&P 500 would get you to 70% of your goal already, which because a lot of those companies are big enough to get into S&P 500. But that's probably one of the sort of goals that I would like to achieve. The other part would be to capture the additional growth or additional segments. For example, if there are changes in the political situation on Russia, it's hard to get that particular exposure when there is the chance by just investing into the S&P 500. So I think back to basics could be one of the themes to play on, but there's also situations where we have to pick at the right time on the right exposures. And also maybe there needs to be an ETF that tracks the biggest companies in each country too. That will help to get your one world exposure. Going back to my point about the market efficiency hypothesis, out of all the mutual funds universe here,
in Thailand investing in Thai equities. 50% of the managers actually do not outperform the market. Some of them have been consistently underperforming the index, and yet it hasn't gone out of business. I'm just wondering why that is actually. Is it due to the ignorance of the retail investors? And can this be that the Thai market is so inefficient from that point of view?
Whether or not it's just inefficient is hard to say, but I think this is a general phenomenon that we see in the market. Even in the US, there are like long underperforming managers that are still alive, but you can see that their asset under management will be reducing, and that one day, well, as hopefully market efficiency kicks in, that would sort of take out the less efficient one. But I think it happens quicker in the US because, well, being an ETF strategist, I think ETF has helped a lot in there because ETF being a low-cost vehicle, tracking the market. If there's a bad manager in the market, charging like 1% of my asset every year, but still underperforming an ETF that is only 10 basis points and matching the market return, I would very quickly in the second year go to my ETF, right? But I think like for maybe the Thai market, there hasn't been ways for me to like get a good enough ETF. Maybe ETF is still pretty expensive in Thailand. For example, 49 basis point. As I mentioned, like a typical S&P 500 ETF in the US charge only like a single digit, 7, 9, or 10. So that's the difference here. And so if there's a manager that in Thailand has managed to underperform the index by only 30 basis points, they will buy the fund manager rather than the ETF. So I think fees would be like the sort of cushion for the inefficiency here for now. But as the market gets bigger, that could help the efficiency to kick in as well. I think you raised a very good point here too. And investors are not stupid, and they will see it. Yeah, it's just a matter of time. So do you have any sort of advice or comments on the fund ETF industry for Thailand?
I have some questions.
Yep.
Can you share with us how ETF is marketed or promoted in some advanced country in Asia? For example, the ETF is picked by the investor themselves or being advised by the advisor. Because right here in Thailand, I think advisors do not advise investor to pick the ETF much. They advise into the product that gives them higher fees. So because I see the size is huge, so I wonder how Thailand can learn from that.
Yeah, I think, well, I'll ask the question back to you. Why have advisors not advising on ETFs then? Because of the charges commissions that they get, right? So I think one, I wouldn't say Asia, but if you look at like the US and Europe, one driving force in advisors promoting ETF is because of the low cost, and also because they have moved many years ago, from the commission-based advisory to fee-based advisory. So before, when it is commission-based advisory, they would very much ask you to go into the very expensive mutual funds so that they can get the commissions or everything. But after they switch into the fee-based advisory mode, they will go for the cheap vehicles that will achieve investors' goals, so that ETF is a very good tool to actually use in their advisory. But so far in Asia, we haven't seen this particular move going on. from commission-based to fee-based. And Singapore is one of the country that have had some consultation in moving from commission-based to fee-based. But the actual market participant feedback is very negative. They say, oh, we are not ready. But obviously, this is a conflict of interest, right? They obviously don't want to have less money, right? So I think it's just very much a, a regulatory move to move from fee-based, from commission-based to fee-based. And also as globalization kicks in, if there's a client, say in Europe or US, is using HSBC for fee-based advisory, when they come to Hong Kong or Thailand, why am I not getting like a fee-based? Why am I charged commission? So one day, well, as time goes on, this hopefully will kick in globally, and that's when at the time would probably have advisors to be more willing to use ETFs, being a low cost. But obviously, I think I would draw back to this picture to, well, ETF is still expensive. I think one reason is also on the size itself, because some of the cost on ETF is fixed cost. If the AUM of the ETF gets bigger, they can do cheaper ETFs. But I think, well, as time goes on, the market gets bigger, fees can, more competition, fees can come down.
Okay. About when you look at the number of ETF in like Hong Kong, Korea or Japan, I want to know how many indexes in that particular country. That is something relative to between number of index and number of ETF.
Relative to, well, I think the more index there are, there could be more ETFs. But the thing is, I think it's more correlated to the size of market, I would say, rather than the actual number index, because sometimes it's the products offerings that are driving the number index. If there's demand for some kind of product, there would be some kind of index that comes out. It's like a sort of negative feedback here, rather than like index being the chicken and then ETF being the egg. Well, it might not be the case. It could be the other way around too. So I think it's more like the size of the market. For example, if the market is small, there cannot be that many variety available, especially like if there's a sector tilt perspective. Well, say a dividend tilt sort of index that they want to sort of set up. There might not be enough constituents to make an index even for a small market. So the size of market could make quite a lot of difference, especially for the fixed income space as well. And that's probably one of the reasons why we haven't seen a lot of China onshore indices and or dim sum bond indices, only one or two recently launched. It's only when the market is long enough, like more than 5 years sort of history, then you with enough sort of constituents, that's the time when you can actually start having an index. So, and that's one reason why US have a lot more indices and also ETFs, because the history is a lot longer for every asset classes. But that's some sort of like I would say, well, we are a bit behind for Asia, but we're catching up fast.
So can I imply that about strategic beta ETF, there is a long time for Thailand?
For Thailand, on the exchange, there's one, which is based on high dividend ETF. So only one that is available for now. But I think if you look at like the definitions that we have here, a lot of like equal weighted is very easily composed with any index. Why not?
Do we need equally weight index before the ETF can emerge?
Sorry?
do we need to have an equally weighted indexes before we can launch first ETF, or we can create ETF
Right. Well,
without index?
it has to be have an index first, but sometimes it's more like the ETF providers seeing there's a demand. They will ask the index providers to create that particular index.
Oh, you mean that some guy need to create an index first?
That's right. Yeah. Say for example MSCI or FTSE, they're willing to provide. Well, they're willing to create the different indices on request.
Can you share your experience in Hong Kong about the proportion of investors who use ETFs? Most of them are retail investors or professional investors.
Well, by definition and by size, it has to be institutional investors that are investing in ETFs. But one of the survey that the Hong Kong Exchange have performed, 20% of the retail investors have been using ETFs too. So that's one of the survey that they sort of publish every 1 or 2 years. Yep. Yeah. But definitely in every market, even the US, by definition or by size, institutional investor has to be the bigger ones. Yeah, I think that's a little bit different in the Thai market. Yeah, I think one of the reasons is on the, on the cost, and also on the adoption or, the familiarity of the product, as well as whether or not the fund managers can actually replicate the index themselves easily enough, rather than using the ETF itself. Yeah. Yep.
That table that you compare ETF Thailand with other countries in Asia, just wonder, have you looked at this kind of table but with mutual funds instead? Because ETF is not the only alternative to stock. You can buy mutual funds too. So I just wonder if maybe it's not about market maker, not about regulators, so it's about the preference of investor. Like you can buy ETF or you can buy mutual funds, and it happens that in Thailand we like mutual funds more.
Well, I haven't got that particular picture here, but yeah, as you said, having like the mutual funds comparison here would be like interesting too, especially that we can use different strategies with ETFs and active funds. Right, probably, yep.
I would like to asking about trading strategy by using an ETF, because nowadays I heard many people talking about trading strategy by using ETF, because maybe they believe that the value won't be able to be zero. Do you have any view to talking about this strategy? Like grid zone or KZM, something like that.
Sorry, I didn't quite get the last part. The trading strategy of ETFs?
Yes, by using ETF.
Sorry, I didn't quite get your question, but I think there are, these are what I explained was the ways that we can use active managers with ETFs, but there are a lot of different ways in which we can use ETFs on a trading purpose or other purposes. For example, there are long short strategies as well. For example, if there's taking the Thai market, for example, if even this particular here, if you're holding a TIDEX ETF here, which is the whole market, the top 50 ETFs in the market, and if, say for example, if you see that the energy sector is not going to perform well, you can short an ETF too on the energy sector. So there's a long short strategy there, which the short portion can provide you with the funding to your long side. So there are a lot of different strategies in terms of trading ETFs. Yep.
As you mentioned in the last answers, like when we would like to shift our exposures from sector to sector, but we still don't want to physically commit the fund to that allocation yet. That you say we can use ETF. So I wonder, like, can you compare the usage of ETF and the derivative? Because we can also use derivative instead to like allocate the fund to other sectors.
That's right. Sorry, I don't have that particular comparison, but this would be a very interesting research to
Yes,
do.
because the major concern is that when I use ETF, right, I need to put the money into it. But if I use the derivative, I need to put only the margin.
Yes, but if you use derivatives, there are other risks, obviously, in your sort of execution. For example, if you're on the margin basis, you are still exposed to the actual risk. So I think your compliance department would be looking at it on a sort of what you call the absolute level rather than the just margin level. Is using derivatives is like a leverage way to invest, but buying an ETF is like you're putting the money in there. Using derivatives is like a little bit like leverage as well as, well, I wouldn't say gambling, but yeah, there are other risks in there.
I don't mean that the way of using derivative to leveraging.
Right.
I mean like I put the margin so that I can open the position in
Right.
the derivative, let's say a future contract,
Right.
and I use the less of money to invest in a risk-free bond or treasury bill, and I get the risk-free rate from that.
Yeah, well, I haven't done that particular exercise, but that would be an interesting sort of study to do. Yep. But it's, well, I want to know the answer too. Yeah. Right. So that's probably the time that we have for today. One more question.
Can we get back to the table about AUM of each country? Can you share us more detail on the competition in like Hong Kong or Japan, top 3 or top 5 ETF fund, are they invest in the same underlying or different underlying index?
If you're comparing between like Japan and Hong Kong, it's very different.
You can give just one example if you know for sure.
Yeah. If you look at like Japan and Hong Kong, they are two different markets. Japan is, although a very open market, is sort of very close, where they have like local investors investing in local products, local exchange as well. So this is sort of their investment mentality too. And the top 5 are definitely the ones that are investing back into the Japanese market. Whereby for the Hong Kong market, it's slightly different. The top 5, 3 out of the 5 have exposure into China, and 2 of them are invested in the Hong Kong market. So in Hong Kong market, by definition, by statistics, over 50% is actually in China. So after all, China is what's influencing Hong Kong, and that's something that Hong Kong has the advantage to, in which Hong Kong is the gateway to enter into China in the investment as an investment channel. Yeah, so this is sort of like the advantage that Hong Kong has got, and this is an important sort of opportunity for Hong Kong too, because in all these countries, only Hong Kong has a very good sort of financial arrangement as well as policies which the China government has given to Hong Kong to invest directly into China. Neither did Australia, Japan, Korea has. So Hong Kong has that particular exposure without competition, I would say. Yeah.
What I wonder is that this is normal that the winner can, I mean, different funds can invest in the same underlying and still coexist as a winners, or just one top fund that will be the best fund for that underlying index.
Usually what we see is that for a particular index, AUM of the top ETF would already account for like 60-70%. The second one gets 10-20%, and the top three are already getting like 80-90%. That's usually the sort of mix in terms of AUM, and because if you think about it as an investor, if there are 5 ETFs that I look at that are available with the same index, it's always the cheaper ones that will probably get my attention, or the ones that has good liquidity, which gives me good execution on a lower total cost basis. So there are only like 2 or 3 ETFs that can give me that particular sort of comparative advantage, obviously. So as time goes on, investors will choose the better ones to get in, so they will gather into the bigger ones and better ones. The biggest gets bigger. So usually that's always the case. And usually it's the local exposure that is has the bigger AUMs in the different countries. Japan, you have the local local TAIEX or the Japanese index being the biggest ETF. China as well, the CSI 300 gets most of the AUM. Hong Kong, Korea has the KOSPI. Singapore has the Straits Time Index, STI. Thailand, the TAIEX as well. So it's always the local index that gets the biggest, local index ETF that gets the biggest AUM. Which makes sense because usually the foreign, the local investors are more familiar with the local market, and they would be more willing to invest into that exposure.
Anybody else? Let us share ideas on how to make money the easy way. No, let me just share this as a parting shot, actually. You mentioned about combining, passive and active. Okay, so basically for passive, I use, ETFs, S&P 500, plain and nice and simple. For active, I use Warren Buffett, which is quite interesting, actually, that I don't have to pay him a dime, So I'm a shareholder of Berkshire Hathaway. And, Berkshire Hathaway will be celebrating its 50th, birthday next year. Warren Buffett's been raking up 19% per annum over the past 49 years. Book value of Berkshire Hathaway, $19, and it's now $138,000. Very nice and simple, long-term. I don't know what to call Warren Buffett, actually, whether it's value investing or passive, but it's mostly buy and hold.
Buy and hold.
Yeah, so I just use these 2 combinations. S&P 500, 10% per annum for the past 50 years. That's good enough for me already. And if you have Berkshire Hathaway clocking up another 19% per annum. Okay, even the Thai market, actually, for the Thai portions of my portfolio, my clients use TMB Z50, nice and cheap, as core holdings. Some of the active managers, you mentioned, Aberdeen small cap. I like that. Expensive, but I like the performance. Aberdeen Growth. I also like Krung Si dividend, equity, but I'm not willing to pay the fees. 2.2. No, seriously, 2.2% per annum fantastic performance, but I just can't bring myself to pay that kind of fees. And the other funds that I like is the Bulong series. Actually, if you go back and look at Bulong Tosapon, over the past 10 years, they've got 10 stocks. And what's really amazing is 10% in BBL, 10% in BLA, 10% in CPO, and portfolio turnover 30%. So I take my hat off to these guys. Actually, they're very sure-footed. They do the homework, pick just 10 stocks, and sit tight. And over the past 10 years, they outperformed the index by miles. Actually, Aberdeen growth, 900% growth versus 300% for the set index. Amazing.
I hope we can have more sensible investors.
Yeah, I know. So,
and actually, you are very focused into Warren Buffett family, because Warren Buffett actually also advised his wife to invest into S&P index.
Exactly.
Well.
So he did say that when he dies, he's going to put the bulk of his inheritance into just S&P 500
Yeah, I think it makes sense,
index.
because everything is over on a total cost basis. So it makes sense for you to not invest into a fund that is charged very expensive, although have a good performance. If they can beat the benchmark above their fees, then it's a good investment. But there takes a lot of work in terms of choosing the right managers to do so. But I think the phenomenon that we see in the Asian market especially is that a lot of investors like to make their own investment decisions. Whether or not to choose their own stocks or choose their own fund managers, and whether or not they have done the homework is the other question, which is the key question too. Or they may be just choosing it by someone talking about it. So I think investor education is very important here. And also the other perspective that is also important is that you talk about long term being 10 years, but in many other Asia investors, 2 years is already long term, right? So it's a very difficult environment that we are facing here. But looking into long term is something that we, as a firm, Morningstar, is very dedicated and looking into. We always advise investors to look long term. It's the long term that gets you to win, not the short term bips or bumps. Yeah. So do your homework and make sure. And potentially Warren Buffett would potentially continue to outperform, but as always, past performance does not represent future performance. So so we have to be aware as well. Yeah. Thank you.
On behalf of the Stock Exchange of Thailand and the partners, today we would like to thank Jackie Choi, not Jackie Chan, right? Okay, for your time and your experience. It is valuable for all of us. Thank you.